Maybe we do start with some of these inflation numbers. Obviously, base effects are making the year-on-year data confusing for many, but 4.2 will get your attention. 1% month-on-month will get your attention. At the wholesale level, I guess the question will be, at what point does it start getting passed down?
Yeah, exactly. I mean, everybody, because of statistical reasons, because of those base effects, braced for some hot numbers. Also, just anecdotally, everyone's focused on lumber, on bottlenecks in production, on trade issues, on what's been happening in metal. So there's no surprise that there's a lot of kind of upward pressure on prices at the wholesale level. It's been the case for a while right now. Then the question is, in the context of Fed official after Fed official coming out and telling everybody, we don't care about, this kind of what's supposed to be a near-term bump in inflation. Do not focus on it because we're not focused on it. And that challenges, the market's ability to kind of, think about two things at once on two separate tracks. And again, this is also happening, with Treasury yields having come back a fair bit in the last several days, and people kind of taking comfort in more of that stability quality trade, not so much the cyclical trade. So I think it's a little noisy at this point. I don't know if anyone's really panicking over it, but it does show you that the market's probably going to have to, get over these potential scares or these little interruptions of this kind of general glide path that we've been on in terms of the macro.
Yeah, David, that sort of ties into what Powell said at this IMF panel yesterday on employment, and that is, a 900,000 print on jobs is great, but we want to see a string of these things before we start communicating that policy is going to change.
Right, which is why they continue to say policy will not change and make it very clear and say, pay no attention here, Mike, you can do that. But the question is whether the bond market will listen. You mentioned, of course, and we take a look at that 10-year yield right now, having moved down from those highs that we saw. What was the correlation between, and I don't even know, above 1.7 or wherever we may have been, and the performance of the S&P, Mike, so we can sort of remind our viewers in terms of that relationship?
Yeah, what's interesting is that the S&P as a whole has not really shown a lot of reaction to either that run to highs in the 10-year yield or the pullback. It's been about what kinds of stocks have worked in the S&P. So this yield back up that we got from mid-1.7s down to closer to 1.6 have coincided with people rediscovering, Apple and Microsoft yesterday were both up like 1.5% for no reason. It was just, those are kind of the bond proxies when yields calm down and when people are looking for quality and defense as opposed to cyclical acceleration type plays. And I think that rotation has been almost perfectly scripted, and you don't know if you can expect it to continue that way. But the overall S&P has just been kind of grinding higher, even as most stocks have pulled back. If you look at the kind of pure reopening type plays, they've pulled back a fair bit in the last couple of weeks, and the overall market has not really had a hiccup. So this whole march higher in yields, it's something, Carl, that we keep saying market's going to have to figure out what its own pain threshold is on that in aggregate. It doesn't seem to be 1.7 necessarily, but at some point along the way, it probably uses that as an excuse to have a little bit of a gut check.
Yeah, interesting, David. Your question about what stocks are going to work from here on out. JPM's got a pretty good note. Dubravko says that March might have marked the end of the momentum unwind. We agree the bulk of the momentum sell-off is done, but we do believe value has more room to run. And clearly, every indication that we get, and we'll talk some more this morning about the reopening signals that we're getting at Disneyland and New York City and hotels. Wynn, of course, on Mad with Jim last night. Maybe that does get you a little more of a kick in those value reopening names.
Yeah, the old value names, of course, that continued debate as to whether they will ever really see a sort of resurgence beyond what we've seen in growth. I mean, I would note that we are up over 9%, roughly 3.5 months into the year on the S&P, and the NASDAQ is lagging. So those growth names, some of them are still lagging, Mike. But, still much unclear in terms of whether that value trade can really sustain itself.
Right. It's still a show-me situation in terms of how much ground has already been made up. What's really, I found interesting about that J.P. Morgan note, too, is just the way you can kind of slice these style categories and what you're actually betting on when you're betting on something that we call momentum or we call value. And one of the issues is that momentum, as it gets measured and played in the market, became very much like value and cyclical because those were the stocks that had raced ahead. And so they automatically start qualifying as momentum. And large cap NASDAQ stocks lost their status as momentum plays in these factor breakdowns. And so you've almost kind of liberated the market from that. Growth is NASDAQ, FANG, and value is energy and financials and nothing else. And momentum is somewhere kind of in flux in between. So part of it is, tail wagging the dog and how are we going to describe these things. But it sort of does tell you why you've gotten this pickup in the NASDAQ names recently, because they were not overextended. They represent a little more defensive in quality. They had lagged, and therefore you can, feel like you're not buying them at the highs. And in a way, they're almost, Carl, orphaned growth. Yes, they're growth, but they're not necessarily impressive this year on earnings growth. But over the longer term, maybe they will be.
Shepard Smith here. Thanks for watching CNBC on YouTube.